Things can go on a long time that don't make sense, but they do come to an end. I mean, the internet thing, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end.
And the longer you hold stocks, the less risky they become, whereas the longer the maturity of a bond, the more risky it becomes.
The man we just saw is, of course, Warren Buffett, widely regarded as the greatest investor of all time. Over the years, despite market volatility, his company, Berkshire Hathaway, has achieved a staggering total return of over 3,600,000%, driven by strategic acquisitions and stock investments. In 2024, Buffett has been selling a significant portion of his stock holdings, positioning Berkshire Hathaway with its highest cash reserves to date. In a three-quarter period from October 1, 2023 through June 30, 2024, Berkshire's stake in Apple declined by more than 515 million shares, or 56%, to precisely 400 million shares. This substantial cash allocation gives him ample flexibility to capitalize on a potential market downturn, similar to the one that followed his 1999 Fortune article. In that article, Buffett accurately forecasted that the then booming stock market would deliver only modest gains for years to come, yielding an average annual return of just 2.5% over 17 years. What's especially noteworthy is that the indicators Buffett cited back then as signs of future weak returns are once again flashing warnings in today's market. Berkshire's recent reductions in major holdings like Apple and Bank of America reflect several strategic factors that may be driving these decisions. Factor number 1. Tax considerations. Buffett has highlighted the advantage of realizing capital gains under the current 21% corporate tax rate, which is historically low. Selling now allows Berkshire to lock in profits and potentially avoid higher taxes if rates increase in the future. Factor number 2. Market valuations. The significant appreciation in Apple's stock value since Berkshire's initial investment has led to a substantial unrealized gain. By selling a portion of its holdings, Berkshire may be aiming to capitalize on these gains, especially if it perceives the stock as fully valued or anticipates a market correction. Factor number 3. Portfolio diversification and risk management. Reducing positions in major holdings like Apple and Bank of America could be a strategic move to diversify the portfolio and mitigate risk. By reallocating assets, Berkshire may be preparing for potential market volatility. Factor number 4. Market opportunities and cash reserves. The sales have increased Berkshire's cash reserves to record levels, reaching nearly $277 billion. This substantial cash position provides flexibility to seize new investment opportunities that may arise, particularly if market valuations become more favorable. It's important to note that while these factors offer insight into Berkshire's strategy, the exact motivations behind specific stock sales are known only to Buffett and his investment team.
The biggest mistakes we've made, by far, are mistakes of omission and not commission. It's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And to do it in a small scale is just as big a mistake almost as not doing it at all. You got to grab them when they come.
A key driver of Buffett's success has been his remarkable skill in making well-timed investments during market downturns. Since he took over Berkshire Hathaway in 1965, the S&P 500 has posted negative returns in 12 years, and in 10 of those, Berkshire still managed to outperform the index. Buffett's advice on seizing big opportunities is essential. Major market drops of 30% or more are rare, while smaller 10% declines happen periodically. The truly significant drops of 30%, 40%, or 50% are infrequent. The last major one occurred in 2008. Some might consider the 2020 downturn notable, but it mainly brought companies to fair value rather than undervaluing them. In 2008 as well as 2001-2002, many companies reached deeply discounted prices. These kinds of big opportunities, just two since 2000, are indeed rare. Even if you view the 2020 crash as significant, the difference in timing is clear. Investing $10,000 in the S&P 500 at the peak, around $3,380, would yield $1,700 today, a 73% return. But if you'd invested $10,000 at the bottom, you'd now have $25,500, a 155% return in just over 5 years. While it's impossible to time the market precisely, the importance of acting decisively when opportunities arise is evident. Warren Buffett gave 2 key reasons for why corporate profits are unlikely to grow faster than GDP for extended periods: competition and public policy. Intense competition limits profit growth, and public policy would push back if corporations took too large a share of the economic pie. Despite Buffett's prediction in 1999 that stock market returns would be weak, interest rates continued to fall to near 0% by 2016. Corporate profits doubled, but stock market gains were minimal, with the S&P 500 rising only 52%, or 6.3% after adjusting for inflation, as the market had been grossly overvalued in the late 1990s. The price-to-earnings ratio, a key valuation metric, dropped from 30 to 24 between 1999 and 2016, keeping returns weak. Today, in 2024, the PE ratio is again at 30, echoing similar conditions. If it contracts to historical norms around 24, future stock returns could be similarly weak. GDP and corporate profit growth projections suggest that unless stock valuations stay elevated, the market may see minimal or negative returns in the next decade. Despite these potential outcomes, Buffett emphasizes that investors should focus on long-term investing, not short-term predictions. He focuses on the valuation of individual companies, not the overall market, a strategy he encourages for those looking to ride out market fluctuations rather than attempting to time the market.
Only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business.
This is very important advice because during a market crash, you're going to hear a lot of companies making the news. In 2020, it was the airlines and travel and cruise companies. Right now, the companies in the news are the high-flying tech companies. But you should never invest in a company regardless of how cheap it's become if you don't understand it. You could have bought Bayer or Lehman in 2008 because it looked incredibly cheap, but that wouldn't have worked out so well for you. So avoid buying individual companies during market crashes just because they're cheap. You have to make sure that you understand them first.
Defining your circle of competence is the most important aspect of investing. It's not how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, he said, "I'm no genius, but I'm smart in spots, and I stay around those spots." That is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else, eventually I'll get green. The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, "I made money last year, I'm going to make more money this year, so this time I'll borrow." Or the neighbor says, "I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year." So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, "This is a lousy place to be." So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. You will see things you won't believe in your lifetime in securities markets. The country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains, it takes temperament.
Defining your circle of competence is one of the most crucial aspects of successful investing. The size of your circle doesn't matter. You don't have to be an expert in everything. What's essential is knowing the boundaries of what you understand and staying within them. As Buffett pointed out, if you stray outside your circle, it's only a matter of time before you face trouble. Prioritize quality when building your watch list, rather than just looking at which stocks appear cheapest. You want to invest in exceptional businesses because time is a powerful ally for companies with strong fundamentals, enabling them to compound value. As a great business continues to grow and succeed, your investment compounds along with it. On the other hand, time can be the enemy of a poor quality business. Focus on high-quality stocks that you can hold for decades, those with strong internal compounding potential. Such businesses are rarely available at bargain prices. But Buffett's strategy has shifted from ranking companies by price to ranking them by quality. He doesn't overpay but is willing to invest if the price is reasonable. This principle becomes especially valuable during market downturns when many stocks appear cheap. However, these businesses may be undervalued for a reason. Instead of getting caught up in low prices, look for companies with solid fundamentals, ample cash reserves, low debt, a strong competitive edge, high returns on invested capital, and sustainable growth. Investing during a market crash requires discipline. When panic takes over, rationality often goes out the window, creating a cascade effect as more investors exit. Stand apart from the crowd by focusing on the long term. Know that the money you put into the market is there for the next 10 years, not just the next few months. If you can commit to this mindset, investing in a downturn becomes much easier. If you found it valuable, hit the like button and subscribe, and I see you in the next one.